Your pension could be the biggest pot of money you ever own, and it's one of the most important tools for building long-term wealth. But if you don't understand how it works, you could miss out in thousands when it comes to your retirement. Understanding everything in this video is going to help you fully utilize your pension and help you build towards that financial freedom in retirement, so stick around. In this video, we're going to cover some core aspects about pensions. These are the types of pensions, how you get free money from pensions, how they're taxed, how each pension type increases in value over time, and how to get your money, as well as a little bit about the MPAA. But first, before we jump into pensions, first a bit about myself. My name's Ross Kelly. By the end of the month, I'll hopefully hold the Diploma in Regulated Financial Planning from the CII. And with a bit of luck, we'll hopefully have the level 6 come November. On this channel, I'll look to break down the important areas of personal finance and retirement planning. The stuff that's often misunderstood or not talked about enough, with the goal of helping you feel more in control with your money and your finances. These topics really matter, and they can be the difference between achieving your financial goals and simply just not making the cut. Again, as always, if you find any part of this video interesting, be sure to drop a like and subscribe. It really helps the channel out a lot. And feel free to leave a comment down below as well, whether it's something relating to finance, something you want to ask about myself, or even what you're having for dinner tonight. I really want to know either way. Now, with that out of the way, let's jump into the types of pensions. Now, there are normally two main types of pensions. There's the workplace pensions, which again can be further broke down into two sections, but we'll get to that. And then there's also the private pensions. Now, workplace pensions are the ones that most people think about when you talk about pensions. They're the ones that normally come from your employer, and again, they're broken into two main categories. These two main categories of workplace pensions are defined benefit and defined contribution. We'll jump into defined benefit first. The defined benefit scheme gives you a guaranteed level of income from your employer. It's kind of just similar to continuing to receive a salary from them in retirement. There are a lot of factors that go into how much income you'll end up getting from a defined benefit scheme, but the most common of these is the amount of time that you serve with the employer. The longer you work for them, the more money you're going to get at the end of it. This normally ends up being a way that each year of service gets you another year entitlement, building up to a certain cap that will get you the full entitlement of the defined benefit scheme. These schemes used to be a lot more common a fair while ago, but nowadays they're few and far between, as they've just ended up being far too expensive for employers as people have begun to live longer and longer lives. The most common place you'll see defined benefit schemes these days are in public sector jobs. Most notable of these will be your NHS workers, firefighters, teachers. These all have defined benefit schemes. The main benefit of defined benefit schemes are their security. It's a guaranteed income for life after retirement. As it's not a pot of money that's sat invested somewhere that's being paid out to you, there's no market risk and no investment risk involved with a defined benefit scheme. This level of security and lack of risk involved has led to these schemes quite commonly being called gold-plated pensions, as you don't really get better. These schemes can also have additional benefits attached to them, depending on the employer. One of the most common benefits that you get with a defined benefit scheme is a spousal allowance. This means that if you die, your spouse will continue to receive a percentage of your defined benefit. A few other of the more common benefits you might get with the scheme is something like a lump sum allowance, or even an early retirement option. However, both of these will likely impact the amount of income you receive moving forward with it. And finally, another benefit of these schemes is that they're normally index linked, so they'll rise with inflation, so you won't need to worry about your buying power being reduced over time. Again, they're really earning the name gold-plated with these types of benefits. The other version of the scheme is called defined contribution. This is a bit more simple, as it's simply what you put in is what you'll eventually get out. The way to imagine a defined contribution scheme is basically just a big pot, and over time both you and your employer will continue to make contributions to it. The pot is then normally invested. This is with the goal to try and grow over time, so you're normally going to see it in stuff like stocks, bonds, maybe even some property. This again is to help increase its value over time, so that the pot is as large as it can be by the time you want to retire. The reason you would want this pot to be as big as possible is, beside bragging rights, what you've put in is what you get out. This pot can run out, so if you use it all, that's it gone. And well, you're going to need to find another job. And as these investments are invested in the market, they're also exposed to market risk and investment risk. So it is possible for a particularly bad day in the market or a tweet from Trump to absolutely tank the value of your pension pot. Of note, you can also get a couple other flavors of these defined contributions, whether it's a personal pension with a SIP, a private pension, or a stakeholder pension. These broadly work in the same way. There is a couple little differences, but for the most part, they all act the same way. So again, it's worth emphasizing the main difference between a defined contribution and a defined benefit is the level of guarantee. Defined benefit, you're going to get the money for as long as you live after retirement. Defined contribution, you're only going to get out what you put in, and once it runs out, that's it gone. Next, we'll move on to how exactly do you get free money from pensions. With the defined benefit scheme, it's simply how much entitlement you've accrued, and that money you'll get for the rest of your life. This money is seen as income and will be taxed as income. So again, it's basically just like you're continuing to get a wage from your employer. The way defined contributions get their free money is a little bit different. It's through tax relief that they get it. For private pensions, for example, you would make the money by basically refunding the tax that you've paid on it. So if you were to put in £800 worth into that pension, you would receive £200 back, as that's the amount you would have paid in basic rate tax. Now, if you are an additional rate or higher rate taxpayer, you'd be able to claim back further by applying to the government. With workplace pensions, it's just a wee bit simpler. Basically, the money that gets put into it isn't taxed at all. So again, to use the £1,000 example, if you were meant to be getting paid £1,000 from your employer, it would get taxed at 20% of the basic rate and you'd receive £800. But instead, with a workplace pension, that full £1,000 just goes straight into the pension pot. Where workplace pensions really begin to flex their muscles is in the fact that employers also contribute to the pension pot. It's not uncommon for the employer to fully match your contribution. So between that and the tax relief, you can be effectively doubling your investment right out the gate. The fact you're getting that type of returns right away with no real risk to you, it's a type of return you're not really going to find anywhere else. A quick side note, you can still put money into a personal pension even when you're not earning. You can put into £2,880 a year, which gets grossed up to £3,600 after the tax relief. So even while you're not working, it's still worthwhile trying to put away as much as you can per year, because that money does add up over time. When it comes to how pensions are taxed, the gist of it is that it's not taxed on the way in, but it's taxed on the way out. But as the pensions grow tax-free, so no capital gains, anything like that, it's a very effective way of minimizing the tax. This is especially true with defined contribution pensions, as you can vary the amount of income that's coming out of it. And as such, you can really get into the weeds when it comes to tax planning and retirement planning to really get that tax bill as low as it can go. Next, we'll move on to how you increase the value of your pensions and how you can look to get more out of them. When it comes to defined benefits, it's quite straightforward. Simply get your entitlement up. Increasing the income you get from a defined benefit normally comes in the way of simply working for the employer for longer. Each year increases the entitlement that you have to the defined benefit scheme, and as such, each year will result in you getting more guaranteed income come retirement. Schemes are also what's called indexed, which basically means that they're controlled for inflation. They'll increase with inflation over time, so if you're taking out the defined benefit for 20 years, you don't need to worry about losing a lot of your buying power. However, even if you leave a defined benefit scheme, that doesn't mean that the money's lost forever. If you only work for it for 5-10 years and then leave and work in a different job for the rest of your life, that defined benefit scheme still sits there and is in your name and will continue to be indexed and grow over time, and you will be entitled to it come your retirement. On the other hand, how you increase a defined contributions pension value is based on two things: how much contributions are going in between you and your employer, and the investment performance of the pot itself. As previously mentioned, the contributions are added, the tax relief's applied, and the money is then invested into the market. This will normally then be managed by some kind of fund manager or scheme manager with the goal to help it grow over time. There's lots of different investments that can go into these pensions. It can be stocks, bonds, even stuff like property can go into it. With a bit of luck, this pot will grow over time, and come your retirement, it'll be the accumulation of your contributions and how well it's done in the market. And now the fun bit. How do you actually get the money from the pensions? Again, with the defined benefit scheme, it's quite straightforward. You just need to reach the scheme's retirement age and then let the money flow. Some defined benefit schemes will let you alter the age at which you can retire. This might be through an early taking of benefits, which would likely reduce the amount that you're entitled to, or a deferment, taking longer to claim it, but will likely increase the amount that you're entitled to. There might also be lump sum options, meaning that you can take a lump sum at retirement just in one go, but this again will likely reduce the amount that you'll get moving forward as an income. You can access defined contribution schemes 10 years before the state pension age. This means that currently you can access them at 56, but in 2028, you're going to need to wait to be 57, and by the time I'm retiring, it's probably going to be like 72. Now, where defined benefits offer security, defined contribution makes up for it in its flexibility, as there's lots of options you can do with the defined contribution once you hit your retirement age. The simplest option is simply accessing the tax-free cash. You can do something called a tax-free commencement lump sum, which lets you take 25% of the pot's value tax-free. You can just take it as a big wad of cash, pay no tax on it. The remaining 75% remains invested and can be drawn on as an income at any time, but this will be taxed as an income. The remaining 75% can also be used to buy what's called an annuity. This is just a guaranteed level of income, and the higher amount of money you have to spend on the annuity, the higher level of income you'll receive moving forward. There's also an option available called Up Plus, which basically lets you take an amount of money out of the fund that is both tax-free and not tax-free. So whatever amount you take out, 25% of it will be tax-free and 75% will be taxable. This really lets you plan effectively around minimizing your tax bill. Again, it's important to emphasize with defined contribution pensions, once that money's gone, it's gone. So you need to be really careful not to run out into your retirement. And while that does sound a bit gloomy, it's also important to spend it. You've worked hard to save up this pot, so don't be afraid to go out and enjoy yourself. It's obviously just about finding a balance between the two. We're also going to quickly mention the MPAA. This basically determines how much money you can put into your pension every single year. The normal allowance for this is $60,000 per year between your contributions and your employer's contributions. This means you can put up to $60,000 away into your pensions every single year. However, this changes once you take a taxable income from your pensions. The $60K allowance then gets reduced to a $10K allowance. So it's really important to make sure you want to start taking this income when you know you won't be putting as much into your pensions anymore. And with that, we've covered all the details I'd like to cover about pensions in this video. Pensions are a really powerful tool, and getting your retirement right hinges on understanding how to use them to their fullest. I hope this video has helped demystify things about pensions, help you understand it a bit better. If you found anything useful, please drop a like and subscribe. It really does help the channel. Also, feel free to leave any comments down below on any further questions you might have about this type of stuff. Thanks again for making it to the end of the video. Third time the charm with this recording thing, so I think it went a bit smoother, a bit better, a lot less outtakes, a lot less footage to edit through, so yeah. If you found this video about pensions interesting, but you're not sure how state pensions work, be sure to check this video here that I've done covering the state pension. And again, thanks for listening.